In this market update, I'm going to talk about what is happening in emerging markets, which is different than the United States, where small company stocks are significantly outperforming large company, and why we think that will continue in the future. Hi, Jim Gore from THOR Wealth Management. We are believers in diversified portfolios, and it is important to have money that is outside of the United States. In this chart here, we're looking at the world and the market capitalization of all the stocks that are available in the world. And you can see here that the US is only 41% of the world's market available stocks. If you add up China, the emerging markets, and Hong Kong, which is now an emerging market in our opinion, you're looking at 25% of the world's stocks that are available for sale are in the emerging markets. And so that leaves roughly about 35% or so that's in other developed world. So if you're not in the emerging markets, you're really missing out on a big chunk of the world. But the emerging markets are totally different. And you want to make sure, and we believe you want to have active management, especially in small company versus large company. And that really shows out here in this chart. These are looking at index funds, ETFs, that are done by iShares. You have EEMS, which is the MSCI Small Company Index, and then EEM, which is the Large Company Emerging Markets Index. Now you can see so far this year, what's happening in emerging market is a complete opposite of what is happening here in the United States, where small companies are significantly underperforming here year to date. What's happening overseas, and we think this is a sea change over there in the emerging markets, you're seeing small company emerging market stocks are doing significantly better and outperforming the large company stocks. And there's a reason for that. And if you look at this chart, this is a breakdown of the two ETFs. EEM, if you look at it, their top 10 holdings represent 23% of that portfolio, with a big chunk of their portfolio, almost 30%, is in China, with some big companies like Tencent and Alibaba near the top. You look at EEMS, that is way more diversified. The top 10 holdings only represent 3% of that index. But note on the bottom there, China is only 7% of the small company index, whereas in the large company index, it's 30%. So if you're investing in an emerging market index fund, you are basically putting 30% of your money in large companies in China. And we think that there's a real problem for doing that. China has a policy of letting companies grow up to a certain point, and then things happen. And that can be really shown here with Alibaba. This is the market capitalization of Alibaba. The market capitalization of Alibaba, which was a fast-growing company, almost reached $900 billion. And then what happened? China went ahead, and we saw Jack Ma missing because he said some bad things about the Chinese government. He was missing for several months. And what happened is the stock market capitalization has gone way down. I mean, we're looking at a stock that's down almost 80%, and the market capitalization has gone from about 900 billion to 190 billion. And this is what happens in China. And that what China does is they allow companies grow up to a certain point, and then all of a sudden the larger the companies get, the more government control. And when they have more government control, just like we're seeing here with Alibaba, that impacts the stock prices. And this is why we think emerging markets, large companies, going to underperform for quite some time. And that's because of what's happening in China. If you don't believe me, there's a great book that I highly recommend that everyone read. And it's called Roulette by Desmond Shum. And this is a story of what China does to entrepreneurs as they get too big. As they get too big, the government comes in, controls them, and we see people missing. And I think this is a book that everyone should read and understand, especially if they're putting money in emerging markets. You don't want to have an index fund, especially a large company index fund. You have a lot more opportunities in small and mid-sized companies being actively managed than you will in the index funds. Hope everyone has a fantastic Christmas and New Year's. And if you have any questions, as always, reach out to us here at thorwealthmanagement.com. Take care, and I look forward to talking to you in 2024.